Hello. In an episode last week, we started to dive into whether Trump's grand strategy was actually working. Now, this involves various different aspects of Trump's current policy pursuits, including a potential Mar-a-Lago Accord, a cheaper dollar, his tariff policy, and a push to reshore US manufacturing. However, the biggest issue that we have to address in the long term is the forever rising debt in the United States. In recent weeks, we have seen some developments emerge on this front. So in today's episode, I'm going to explore what these developments are and how they have led to sharply rising long-term yields in the US bond market. These are the near-term impacts, but in the longer term, I will also explore the warning signs that the bond market is flashing and what potential narratives could unfold over the next few decades. So to begin, I will dive into Trump's big beautiful bill. This is Trump's spending bill, and for lower income citizens within the United States, this bill will likely be seen as less beautiful than Trump is proposing that it is. For any citizen who earns above $51,000 a year, they will earn more after-tax income as a result of this bill. But for any US citizen earning less than $51,000 a year, they will actually earn less income after tax as a result of this bill. The biggest gains seen in this bill are via reduced taxes for millionaires. To further impact lower income citizens, this bill makes it more difficult to qualify for tax credits and will slash billions from support programs that benefit lower income citizens. So from his campaign, where he promised that he would prioritise those of the working class and of lower income, Trump has said one thing and he's pursued another. As is often seen, though, this likely won't have a negative impact on support amongst his most passionate voter share. Trump has been set on reducing deficits in the United States. This does need doing because no action has been taken to address rising debts, and if interest rates remain elevated, payments of interest on this debt will rise. This then risks entering an irreversible spiral where interest rates continue to rise and the payments on debt also continue to rise until the interest rate payments are larger than any income the United States makes. At this point, this spiral becomes irreversible. But according to reports in the last week, Trump's big beautiful bill will actually increase the US deficit by trillions over the next decade, and it will ensure that deficits remain between 6 and 7% of gross domestic product. What could lead to an even bigger negative impact would be bond yields sharply rising, as we have seen. The 30-year yield rose to 5.1%, which is its highest level since 2007. Remember here that bond prices and bond yields are inversely correlated, so when bonds are sold and prices fall, we see bond yields rise. After the United States confiscated Russian foreign exchange reserves that were held in dollars, other nations have started offloading their treasury holdings. We've also seen bond yields rise further as investors worry that interest rates will rise once again because Trump's tariff policy could see inflationary pressures return. But the biggest question to answer here is why we are seeing yields rise more at the longer end of the curve versus shorter maturity bonds. In recent weeks, Scott Bessent has shown confidence that many trade deals will be signed with the US and countries around the world. However, as I've alluded to in the last few weeks, Trump doesn't hold all the cards here. The world needs the United States, yes, but the United States, and specifically its bond market, also need the rest of the world. If nations around the world decided to coordinate and offload their US debt that they hold in the form of treasuries, and if no trade deals were signed between US and other countries, then somebody else would have to buy the US debt. This would likely fall on the United States, who would have to buy its own debt. A risk of this is being seen in treasury market auctions, which, especially in the long end of the yield curve, have been incredibly weak. However, with interest rates elevated and inflationary pressures returning due to Trump's tariff policy, the Federal Reserve has a big role to play here. If inflation does return, they will likely raise rates to counter it. Since higher interest rates means less economic growth and less spending, this could put further pressure on the bond market. Events such as this, where interest rates rise to tackle inflation and payments on interest grow forever higher, that can lead to devaluations or restructurings of debt. In the worst case scenarios, it can lead to a complete redrawing of the global financial system. And an issue such as this surrounding debt has typically contributed to the collapse of empires in the past, and it eventually leads to changes in global reserve currency and currency systems. So, to summarise this in a sentence, the issue of US national debt is huge. This is why the long end of the bond curve is seeing a sharper rise in yields. The US debt situation isn't going to unfold tomorrow, but in 30 years, who knows what could happen. With this rising uncertainty, in the long term, bondholders are selling, which is increasing yields, because any bondholder wants to receive a greater financial reward for holding US debt that is now seen as even more risky than Greek debt. Remember that the Greeks famously had a collapse in their debt markets as a consequence of the global financial crisis. Well, what happened here is that they relied too heavily on debt to balance their books, and when a recession struck and economic growth declined, it made it more difficult to raise money towards debt payments. Credit agencies then downgraded Greek debt to junk status, which led to even more selling of bonds and higher yields. Again, this occurred because bondholders wanted more financial reward for higher uncertainty for holding Greek debt. The effects of this event were felt for years after this, with IMF borrowing and austerity practices heavily affecting Greek society, and unemployment skyrocketed as a result. Now, because Greece was a part of the euro, they couldn't print more money, nor could they change interest rates, because this is something that is set on a European-wide basis. These are both tools that the United States can use, but if the United States was to print more money, surely this would increase inflationary pressures, which would again lead to a rise in interest rates, and lo and behold, the cycle repeats. One aspect here that I've not discussed is another bill that has recently been travelling through the US political system. This is the Genius Act, which is Trump's stablecoin bill. Crypto czar David Sachs has stated that this bill could boost demand for treasuries by unlocking over $200 billion in stablecoins. Deutsche has reaffirmed this, stating that stablecoin transactions hit 28 trillion globally last year, and that such a bill will ensure the reign of the dollar as global reserve currency. Regulation as a part of this bill could provide confidence in stablecoins as a key part of the future digital payment system that currently revolves around the dollar. Despite some initial worries that this bill would see Trump benefit personally via his blockchain project and his personal crypto holdings, the bill has passed, and this is ushering in a new period of stablecoin use. But this doesn't make much of a dent in the overruling narrative here that rising US debt and inflationary pressures are a huge problem. Interest rates remain elevated and Trump wants them cut, but Jerome Powell has 1 year left as chair of the Federal Reserve, and he is going to focus on inflation. If, after this year unfolds, inflation has risen and Powell has raised interest rates to fight inflation, but inflation hasn't been beaten, Trump could appoint a yes man into the position of chairman of the Federal Reserve. One such scenario that could unfold from this is that inflation remains elevated and this could eat away at US debt, but for everyday US citizens, this would crush their quality of life. Especially with Trump's spending bill hitting those from lower income backgrounds, there are major economic risks that we're seeing spout here. Time will tell how these strategies come together, including some that have unfolded earlier in Trump's presidency, such as the Department of Government Efficiency, which was implemented to attempt to cut federal spending, but we've seen little impact of that thus far. But in general, if this narrative of rising US debt continues to unfold and continues to worsen, Trump could have a massive job on his hands. That's all for today. I've been Dylan. I'll talk to you next time.